Is this recording? Recording to the cloud, yeah. All right, perfect. And so are you going to be able to jump in and admit?
That's what I will do.
Okay, perfect. All right, can someone in the chat let me know if you're able to hear me? Perfect. Thank you, Michael.
Recording in progress.
All right, for those who are in person here, does everyone have worksheet? And make sure you sign in. Ready to go? So I don't hear myself. All right. Welcome to everyone. For those who don't know me, I think one of my students here, I saw some names that I am familiar with online, but I'm Coy Chambers. I'm one of the accounting professors here. And so I'm going to be going through exam 2. I'm assuming all of you guys are going to be taking this week sometime. And so basically chapters 4, 5, and 6, we have a problem from each one of these to make sure that we feel comfortable with our adjusting journal entries, our bank reconciliation, and then our sales and inventory journal entries and all that fun stuff, right? So the way that I like to do this is basically give you a few seconds or a few minutes to go through this first one here, just chapter 4, and go ahead and try it out on your own. Because I know this stuff. I want to make sure you guys know it, right? And if you don't know it, this is the best way to figure out where you may have gone wrong, right? So give you just a few minutes to go ahead and work that out. And then we'll pick up here and go through and make sure that we know what we're doing.
That's it.
So again, on this first one, we are looking at adjusting journal entries. So we've got our trial balance there. Make sure that we pay attention that we're looking at March 31st. And so we're looking at adjusting entries for March. Did you post the attachment in the chat so they can download it? Or do I have to?
You will have to, because what I do, I just.
Oh, because I've got
I
the,
just, okay, for those online as well, okay. We can do that. Mhm.
so for those that are in my online section 13 and 14, it should be available in the exam 2 review folder or module. And I'm gonna try to see if I can go ahead and get it posted here on the chat. So that should be the blank document there in the chat. All right, are we ready to go through this first one? All right, so again, trial balance for Laurie Rental Agency on March 31st of the current year includes the following selected accounts before adjusting journal entries have been prepared. So we've got our accounts listed there, and it says we've got 5 different entries that we need to make here. And so it says the first one, an analysis of the accounts shows the following. So for letter A, the equipment depreciates at $500 per month, right? So what do we always debit when we're dealing with depreciation?
Depreciation expense.
Depreciation expense. And what do we always credit? We always credit accumulated depreciation. And so since this is per month and it says that we make them monthly, what is my amount going to be? 500. So if we wouldn't have recorded these yet up until this point, right, we would have to adjust our calculation. But it says that we assume that they are made monthly, so January and February have already been taken care of. So we just need to worry about the expense in March. What type of account is that accumulated depreciation? So remember, that's a contra asset account. That will show up. If not on this exam, it will show up on the final. All right, so it's reported with the assets, right, but has the opposite balance. So by crediting that contra asset, we're increasing that accumulated depreciation account. Okay. All right, letter B. 2/3 of the deferred rent revenue was earned during the month. So what account am I going to be looking at? So we're going to be looking at rent revenue. That's going to be part of it. But what account do I need to look at in terms of knowing how much needs to be recognized as revenue? So I need to be looking at deferred revenue, right? So we've got $9,000 sitting in deferred revenue. And what is deferred revenue? What kind of account is it? So it's not an asset. Why is it a liability?
It's because you haven't been paid yet, right?
So we've already gotten the money, right? So
You have to do
we still have to do the work, right? Deferred revenue is when we get the money before we do the work, right? So it's a liability because we owe them the goods or services, right? In this case, rent. All right. So in this case here, it says that 2/3 of that account has been earned. So what is 2/3 of my account? Yep. So we got to base it off of the 9,000. 6,000, right? So 2/3 of 9,000. Okay. So we got 6,000 here, 6,000 here. So what are we going to do to deferred revenue, debit or credit? We need to debit that account because it's currently got a credit balance. So we're going to take that out of deferred revenue. And where's it going to go? So I think there's a better account than service revenue. Huh? Rent revenue, right? Because it's saying deferred rent revenue. And so that would be the better account to use. The key part of that is that it's an earned account, right? So it's service revenue, sales revenue, in this case, rent revenue, right? Whichever revenue account is pertinent to the company that we're working with. Okay. Now, what about letter C? We've got some consulting services that were earned during the month, but it hasn't been collected, nor have we billed it to the clients for 1,500. So what's happening here? So consulting services earned, what should that tell us we're looking at? What kind of account? So if it's earned, right, we're looking at revenue, right? And what else? So it's not a liability, right? Because do we owe them anything? They owe us, right?
So it'd be accounts receivable.
Accounts receivable is going to be the best one for this, right? So we've got consulting services earned tells us revenue, right? And then not yet collected or billed tells us that the client owes us money, right? So if we've got consulting service revenue and accounts receivable, right, both of those are increasing. Which one gets the debit? Accounts receivable, very good. So that means that our credit is going to be consulting service revenue. Could just be consulting revenue, service revenue, any of those, as long as you, unless your instructor tells you otherwise, I would say as long as you make sure that you specify that it's revenue or an expense. I think most of us are kind of lenient in the, I guess, the nomenclature, right? So as long as you put revenue, whether it's service revenue or consulting revenue, consulting services revenue, I know for me, I would count all of those the same.
So say it's like a different, like, say we're not consulting, but we're like, I don't know, selling a product, like, would you, whatever, like, the selling you do, would you just write that, like, the service revenue? That makes sense?
So the question, so just to make sure I understand and for chat, so you're saying instead of if it was not consulting, right, if we're just selling a product,
Yeah,
what would we put instead of consulting services? Just whatever account, kind of like we just did with rent revenue. It would be whatever we were doing,
okay,
right? So if we provided them rent, like a space for rent before they paid us, then it would still be accounts receivable or rent receivable. And then we would have rent revenue, right? Or if it was sales, it could be accounts receivable and then sales revenue, right? As long as it's revenue and you're kind of close on what it involves,
yeah,
basically.
got it. Makes sense.
Yeah. As long, because deferred revenue is a whole different thing, right? As long as you don't put deferred revenue, I think you would be okay. All right. Any questions on those three so far?
Just maybe contra assets.
The contra assets. So contra means opposite, right? And whatever the next word is where it's attached. So if we're looking at a balance sheet, right, we would have equipment, and then we would have less accumulated depreciation. So in this case here, we've got $40,000 of equipment. We've got the 12.5 of accumulated depreciation before our adjustment. So if we look at, we're looking at T accounts, right? Our equipment, here's our 40,000. And for accumulated depreciation, there's our 12.5. Right? And so now what we're doing here is we're crediting 500. So now that makes it 13,000. So remember our assets act like this for debits and credits. Contra means opposite, but it's attached to it, right? Because if we think about the other one that I usually use for that is we're going to look at supplies in just a second, right? Whenever we use up those supplies go away, right? So we're going to credit supplies as we use supplies, right? But if we have equipment, right, like this computer, right, these desks and chairs, if we use them, do they go away? No. So we can't credit the equipment account, right? So we have this special account called accumulated depreciation that basically accumulates all the depreciation that we take against those assets. And because it's opposite, right, and it's reported with it, we would basically have a subtraction here. And then, what is that, 27,000, I think? So this would be what we call book value or net value, right? So that's not what it's worth, right? We could sell it for 30,000. We could only sell it for 10,000, right? Because remember, our books are based off of cost, right? So that's the cost of the equipment minus our estimated depreciation that we took up until this point.
So it's kind of like saying, you got $13,000 worth of use out of your equipment so far.
Correct. Yeah, we've used, right? We've incurred that cost. Because again, remember when we recognize expense, we have to recognize it in the period that we used it, right? So March, we only used $500, and I'm putting that in air quotes, right? Of that thing, right? And so we basically are using that equipment to earn revenue, and we want to make sure that any expense offsets the same revenue that it helped generate. Because again, we're trying to compare apples to apples in the long run, right? So if we have something happening in March in terms of revenue, we want March expenses to offset that. What else we got? Okay. All right. So going straight into letter D, supplies on hand, $800. So what account do I need to look at? So supplies and supplies expense. So if we're looking at supplies, my unadjusted amount is 2,000. Right? So 1, 2, and 3. Where does that 800 need to go? Because so you're saying that it goes here?
Yeah, because you, oh, no, because you subtracted it from the supplies, right? So you put it like where the ones.
So you're saying here? So if we put it in 1, right, that's adding to our supplies. 2 is subtracting from supplies. So what is 3?
Something.
So 3, right? What is the 2,000?
How many supplies we had? Just
How many supplies we had before we adjusted it, which would be basically what we had on hand, right? So how many do I have on hand now? 800, right? What are supplies? What type of account is it? It's an asset, right? So if I have $800 worth of stuff, right? It needs to go here because that's my adjusted balance. So this is my adjusted or on hand balance. And so we got to make sure that we are paying attention because it could say supplies used $800. In that case, this is what we used, right? So this would be purchases. This is used, and this is on hand. Okay. So if we've got $2,000 sitting in that account right now, and we only have $800 of supplies on hand, we can't report $2,000 on our balance sheet, right? That's not right. So we need to figure out how much we used. So what credit amount would make this work? 1,200, very good. So this is how we get from point A to point B, right? From 2,000 down to 800. So we know our amounts and we know that we're going to credit supplies because that's what we're doing here. As I use up those supplies, what account am I going to debit? Why is it supplies expense? When do we recognize expense? When we used it. What did we just say that $1,200 was? What we used during the month, right? So they're no longer assets, right? They're not providing us any future benefit because we've already used their benefit, right? So we're removing them out of supplies to take that balance down to what we actually have on hand. And then as we use those supplies, their cost becomes expense. Okay. All right, letter E. We've got a 1-year insurance policy was paid for on March 1st of the current year. So we're looking at prepaid insurance and insurance expense. Because again, as we use up assets, their cost becomes an expense, right? So that's prepaid expense, that's supplies, and theoretically that's equipment, right? But we don't take it out of the equipment, right? We take it out of that or put it into that accumulated depreciation, right? But those 3 journal entries are essentially the same thing, right? Because we're using up the prepaid insurance or we're using up the supplies. And so we do the same thing here. But now we have to figure out the amounts, right? So this says that a 1-year insurance policy was paid for on March 1st. So how much is that going to be per month?
that number divided by 12.
Yep. So what's 3,000 divided by 12?
250.
250? So we got 250 per month. You want a worksheet here?
Oh, yes.
And make sure you sign in before you leave too, please. All right, so we got $250 per month, right? How many months have we used this insurance policy? How do we know that? How do we know it's 1 month?
It was paid on March 1st. and we're gonna give it a month.
So we bought it on March 1st. When are we recording these journal entries? On the 31st, right? At the end of the month. So we've used 1 month, right? So we know my adjustment needs to be 1 month's worth. Okay. What am I going to do to prepaid insurance? We're going to credit prepaid insurance. And as we've used that insurance, where is that cost going to go? Insurance expense. Very good. So then if we looked at a T account for my prepaid insurance, we started with 3,000, which is 12 months. How many months should I be left with? 11, right? So if we multiplied that out, we would get 2750, which leaves this as my AJE for 1 month.
Swimming up to 3,000, it's like for the whole year.
Yes, without any other information because it says it's a 1-year policy and it was paid for on March 1st. So if it's an entire year policy, then the original journal entry would have been a debit to prepaid insurance for the 3,000 and a credit to cash. Yeah. And there's we'll post the answer key in the chat, and also I think there's some copies in here for you guys. So it's a little bit nicer and neater than this. So if you want that, you can get it at the end as well. Okay. Any questions on those 5? All right. Give you a few minutes here and let you do this bank reconciliation. And so before you get started, we'll set up the template here. So remember, we have the bank side and we have the books side. And so we have our balance to begin with. And then we have our additions and our subtractions for each. Then we have our adjusted balance. for the ones in here? Not good?
I couldn't picture this thing, so.
You weren't here for the, okay, perfect. All right, so what is the purpose of a bank reconciliation? What are we doing? So we're trying to make sure that the book that we have, right, matches the bank, right? Because are our books and the bank account ever going to show the same amount of cash? Potentially, right? But more likely not. Why would our books and our bank account not match in terms of our cash, right, being what's in the bank account versus our cash, what should be in the bank account that we're showing on our books? Why might there be discrepancies?
Maybe like. We haven't received the money for the services that we've like done, like maybe those checks that we're still waiting on, or like.
So there's timing differences, right? So how many of y'all have written a check? Right? If I write a check, does it come automatically out of my bank account? No, right? So if I process a check on my books, right, out of QuickBooks, right, that's my ledger. If I write a check out of QuickBooks, it deducts that money right out of my cash account on my books. But then what do I have to do with that check? I have to send it, right? It's going to take a couple of days to get to whoever I'm sending it to. They're going to have to deposit it in their bank, right? So there could be, several days to a week or so between when I write my check and when it actually processes through the bank, right? So this is basically just to make sure that we understand why there is a difference, right? So what does reconcile or reconciliation mean? To make up, right? To figure out your differences, right? If you have a fight with your friend and you reconcile, right? You settle your differences. That's what we're doing here, is explaining the differences, right? So we have to start with what our current balances are on both sides, right? So what is my current bank balance? So 9,333. So per the bank, right? 9,333. Okay. What about for my books? 10,045. So per books, 10,045. Okay. Now, the way that I like to do this is normally we have issues with deposits being outstanding. We normally have checks outstanding. We sometimes will have bank service charges. And then we have other stuff. So this is kind of the way I do it. Because if you haven't done your assignment yet for chapter 5, right? Deposits, checks, bank service charge, 9 times out of 10, those are going to be on every bank rec that you do. And then there may be other stuff. So if you get into the process of doing this, then it's a lot easier when you get to the exam because we have a process to follow. Okay. So do we have any outstanding deposits? Which number? So number 5 right here, right? So deposits in transit on July 31. What does that mean? It means on the way, right? So if July 31 is Friday, right? And it's 9 o'clock at night, is the bank open? No. So if I close down my shop at 9 o'clock and I go take the deposit for stuff that happened on July 31, if I took it to the bank, when is it actually going to show up on my bank statement? On August 1 or the 3rd, right? Depending on when they process my deposit, but it's not going to be in July. So when I get my July statement, it's not going to have these deposits. But where are those deposits recorded? Why are they recorded on our books?
because you do your boost.
So whenever we get the money, right, we're collecting the money, so we should be recording the cash coming in. And then we're going to process a deposit in the system, right? And then we're basically going to have it on our books, right? So it's processed on our books, but where hasn't it processed yet? The bank. So we need to put it on the bank side. And once that does go through, is it going to add to our bank balance or take away from our bank balance? It's going to add. So here's our deposits in transit. And so that's going to add 2,100. So we've taken care of 1, 3, and 5. So now, do we have any checks that we need to reconcile? Number 9, I don't know why it skipped from 6 to 9. Who knows? But it's number 9 on this in this case. All right. So outstanding checks, those are the ones that we've written, right? And that we've basically sent out, but they haven't cleared our bank account yet. So where is it reported correctly, on the bank side or the book side? So where is it recorded correctly? Why is it on our books? Because where hasn't it processed through yet? It hasn't gone through our bank account yet, right? So if it's correct on the book side, on the right side, where do we need to update it for the reconciliation? The other side, right? So if it's on our books, it needs to be on our bank side. And when it does process, right, when our bank does process those checks, is it going to increase or decrease our bank balance? It's going to decrease. So here are our checks outstanding. So that's going to be a subtraction of 594. All right. So we good with that? All right. Do we have anything about a bank service charge? Number 4. Number 2, right? So it says that July bank service charge was not recorded by the depositor. Who's the depositor? Huh? We are, right? We're the depositors. Okay. So this was not recorded by us yet. So who was it recorded by? So if it's recorded by the bank, where do we need to update it? On the books. So it's going to go on the right side with the books. And did that add to my bank account or take away from my bank account? It took away, right? So what do I need to do on my books? I need to subtract bank charge minus 22. Okay. So then we have other stuff. So we'll just go down the list from here. So number 4, it says that the bank charged 2 guys' account $350 for a customer's NSF check. What does NSF check mean? Non-sufficient funds, which is what? A bad check, right? So what happened with that? It bounced, right? So where is it recorded correctly right now? So I got one book and one bank. Explain yourself.
They sent out the check or whatever, but then they didn't realize that it was bad at the time.
So what would have happened, right, is we did the work, right? They gave us the check. On the books, we would have had a deposit, right? We took it to the bank, we deposited in the bank, right? Just like right here, right? It would have been included in something like that. Then our bank takes that check and basically sends it to the person's bank that wrote the check, and they ain't got no money, right? So the bank, their bank's not paying for it, right? So they're sending the check back to our bank. And what did our bank just do?
Fee for giving them a bad check.
Well, they didn't charge us. It doesn't say anything about charging a fee, but yes, right? But what did they do with the check amount? They would have added it originally, right? Because whenever we deposited it, they're assuming that it's a good check, right? So they put the money in our bank account. Now what did they just do? They took it away. So where is that money accurately reflected? It's on the bank, right? So where do I need to update it? The books. And is that going to add to my cash account or subtract? It's subtracted. So there's your 350. Any questions on that one? I know most of you have not really written checks and know how that process works, right? As students get younger and younger, right? But any questions? Okay. All right. We have another other stuff item, and we have an EFT deposit. The bank collected a $1,166 account receivable. So what does EFT mean? Electronic funds transfer. So our bank collected one of our accounts receivable, and they deposited it into our account. So who's got the accurate record of that? Us on the books or the bank? The bank, right? Because the bank collected it. So until we get the statement, we probably didn't know about it. Right. And so now that we've got our bank statement, we see that they collected and put $1,166 in our bank account. So what do we need to do on our books? We need to add that, right? Because it's a deposit. So we're going to add 1,166. And notice that we've gotten rid of all of our line items there. So now the last thing to do is to take each one of those columns and get the adjusted balance. So what is my bank balance? 10,839. Okay. And what is my book balance after these adjustments? $10,839. What do we notice about them? They equal. They have to. If there's still a difference between them, we haven't explained or reconciled all of our differences, right? So we must have those two numbers be the same. It's kind of like our balance sheet, right? Our assets must equal our liabilities plus equity. Here, my adjusted bank balance must equal my adjusted book balance. And essentially what would happen is if we just stopped operations, if we did nothing else, right? Basically, once everything processed, this is where we would end up. And our books and our bank would match.
If we do something wrong, would this be a way to tell if they didn't match?
So yes and no, right? So if we screwed up on the reconciliation, right? If we didn't put something on there obviously we would have done something wrong on the reconciliation part, right? This doesn't tell us if we did everything right in the books, right? Because we could have classified something incorrectly, right? Once we get to this point, our trial balance is balanced. So from that perspective, it looks like we've done everything correctly, right? Now, if something's been transposed or something like that, then we may catch it here. Like this is just another check and balance point, right? So just because they're equal doesn't mean that we've done everything right for every part of the process, but it's another good point of checking, right? Because this is, again, that's what we're doing here. And then the real world, instead of it just saying checks outstanding, you're going to have a list of however many checks processed that month, right? And it could be 50 checks. And so you're going to go one by one and check off everything. And then you're going to have the ones outstanding, right? Any other questions on the bank reconciliation? Okay. Now that we got to this point, it says to journalize the adjusting entries for July 31 on the books of Two Guys Moving Company. So there's two things here. One, we already know where all of our adjustments are coming from. Where are my adjustments coming from? So these require adjusting journal entries. What account am I dealing with here? Cash. So if I'm adding to cash, what am I doing? So anything here, we're going to debit cash. That's half of my journal entry right there. And then for the less, what are we doing? Well, we're crediting cash on the left side. You're ahead of me. So we're debiting cash and we're crediting cash for those things. So that means we still have half of a journal entry to figure out, right? We still have to figure out that other account, but this at least, if you know nothing else, you can at least get partial credit more than likely, right? So we'll start with the EFT deposit. So we know that we're going to debit cash for 1166, and I need an 1166 credit. So over here, no journal entries. Why? Why are there never journal entries on that side?
We can't change what the bank.
We can't change what the bank has, but where is all of this already recorded? Where are those deposits recorded and where are those checks recorded? They're already recorded on our books, right? So we can't do anything for that stuff over there because it's already on our books. Debit. So we're debiting cash for 1166 and we need an account for our credit. What account are we going to credit here? Well, the EFT deposit says that the bank collected a 1166 accounts receivable. So what do you think your credit account needs to be? Accounts receivable, right? Don't let it be harder than it is, right? So that was to record the EFT deposit. Okay. We good with that entry? All right, the bank service charge. So obviously we're crediting cash here for $22 and I need a $22 debit. And so this is recording bank charges. What is my debit account going to be here? So accounts payable, what else? Bank fees. So why did we think accounts payable?
Well, looking at it, it says the.
So we'll still go through the process, right? Because I'm sure there may be others that thought accounts payable, right? So what is accounts payable used for? Things that we owe, right? Did we owe this previously? No. Are we paying off anything we owed? No. So you would have gotten there if you would have done that, right? So we don't have a payable here. So what is the best option? It's an expense, which we're going to call bank charges, bank service fees, right? It's an expense. So normally bank expense could be it. Normally it's bank service charges or bank fees and stuff. The bank charges is one of the only accounts that I normally see that doesn't have expense at the end of it. Right? Most of everything else usually notates that it's an expense. And this is an expense account, right? But it's bank charges, bank service fees, something of that effect. Okay. And then we've got our NSF check. So again, we're crediting cash. So we're recording our non-sufficient funds check for $350. And what does my debit account need to be for this non-sufficient funds check? Where does my debit need to go?
On the, like, question.
So I got accounts payable. I got bank fees. So I don't like bank fees for this one because are we expensing anything? What were you going to say over there? Not bank charges. So I got accounts payable. So if we debit accounts payable, what are we doing? Are we increasing or decreasing our accounts payable? We're decreasing. Are we paying for something that we owed? What's happening if we debit accounts receivable? Are we increasing or decreasing the accounts receivable if we debit it? We're increasing it, right? So that means that we have $350 more to receive. Is that what happened here? Because what would have happened, right, is we would have debited cash and we would have credited, well, sorry, let's back up. We would have debited accounts receivable and credited sales, right, for the beginning one. Then we would have debited cash, credited accounts receivable when we got the money originally, right? But now what's happened? They don't have the money. So what needs to happen to their accounts receivable? It needs to go up, right? Because if I owed you money and I gave you a bad check, do I still owe you money now? Yeah, even though we basically canceled it out here, right? This basically never happened, right? So then we need to debit our accounts receivable to put that money back on our books. And they already took that money out of cash. So we're going to debit accounts receivable. Yeah. Yeah, it's printed out. All right. So we got chapter 6 here. Give you just 2 or 3 minutes to go through and see how you do on the September journal entries. And then if you get to it, we're looking for net sales, gross profit, and then gross profit percentage. I'll give you a couple minutes to go through that. Yeah, so chapter 6 is normal journal entries, but instead of us using the service-based business, we're doing merchandising, right? So we've got inventory, we've got cost of goods sold, we got sales, we got returns possibly now. All right, so we're gonna go ahead and try to see how we're doing on these. Okay. So we're using a perpetual inventory system, and this is for September. And so September 6th, we purchased 70 calculators from Danny Company for $1,400 on account. So what accounts are involved here? So how do I know it's inventory? We got calculators, right? And then how do I know that it's accounts payable? So we bought them on account, right? So which one gets the debit? So we're going to debit inventory. And we're going to credit accounts payable for 1,400. So inventory, we just debited for 1,400. Accounts payable, we just credited for 1,400. Okay. On September 10th, we returned 5 calculators with a cost of $100 to Danny Company that did not meet our specifications. So what accounts are involved here? Accounts payable and inventory. So essentially what we just did, right? But what are we going to do? we're gonna flip it, right? Because if we return calculators, we're reducing our inventory. And what does that do to the amount that they owe us or that we owe them? It goes down, right? Because I'm not gonna pay for $100 of calculators that I didn't keep, right? So it's not accounts receivable because nobody owed us money, right? We're getting the cash or they're giving us the credit for that before we paid them. Correct. So if they would have given us cash, then we would have debited cash. Or if they owed us money, right, then it could technically be like an accounts receivable. But since they're a vendor, even if we paid them, more than likely, if it was a vendor that we normally use on a regular basis, we would have just let them credit our account and we would have had money kind of just quote in the bank. Does that make sense over there? I saw the eyes. What we got?
I don't know why, just like, why'd you put it on account instead of just like paying cash or just whatever you, other way you can do it.
Oh, so we're reading a little more into it, right? So we put it on account here. One, normally businesses have trade accounts.
I mean for the, when you return it, you put it on account table instead of,
Yes, because so we credited the account here. I owed them 1,400. Have I paid them the 1,400 yet? No. So if I send back $100, do I still owe them 1,400? No. So how much would I owe them if I sent? So we have to debit accounts payable. If we would have paid them, right, and they would have sent us cash, then we would have debited cash. But basically, we just undid $100 of what we just put on the books. Okay. All right, so then we have $100 credit there. So currently we got $1,300 of inventory, $1,300 of accounts payable. Okay. Now, on September 12th, we sold 30 calculators for $900 to the Great Big Bookstore on account, and those calculators cost us $600. So in the prior chapters, whenever we sold something or had revenue, we only had one journal entry, right? How many do we have whenever we sell something in a merchandising? We have two, right? What's the first journal entry recognize?
us making the sale.
Us making the sale, right? So on 9/22, right? Number one, what is the sale?
So.
900.
So we got $900. What are my accounts? So accounts receivable because we sold them on account. So Great Big Bookstore owes us money. So do we debit or credit accounts receivable? So we're going to debit accounts receivable. What am I going to credit? Sales revenue or just sales? Yeah, thank you. No, you're good. You're good. All right. So then the second one, what do we recognize?
We lost it.
So inventory went out the door. So now we need to update the $600. So inventory left. So do we debit or credit inventory? So credit inventory. And where does the debit go? So what do we call inventory expense? There's a special account. not inventory expense. There's a special name for it. So it's cost of goods sold, which is inventory expense, but we don't call it inventory expense. We call it cost of goods sold, or a lot of people will just say COGS. We like our acronyms in accounting if you haven't figured that out yet. So cost of goods sold, right? It's the cost of the goods that we've sold, which is essentially inventory expense. And so going back to those adjusting journal entries there, right, earlier, as we use up the asset, right, we would debit an expense account, right? So that's what we're doing here. We just call it cost of goods sold, but it does act like an expense account for inventory, right? So you're not wrong. It's just not the typical lingo that we use. Okay. So remember, whenever we sell merchandise, we always have two journal entries. We record the sale, right? The actual revenue portion, and then we have to take care of the inventory, right? Because when we were doing service work, we didn't have inventory, right? It was just us, right? Our skills and abilities, right? We were providing a service. Okay. So if we take accounts receivable, we've got 900. We just took out inventory of 600. So we're left with 700 of inventory, I believe. Okay. Now on September 14th, we granted credit to Great Big Bookstore for the return of 5 calculators. The sales price was 150. The cost was 100. So if we have 2 journal entries when we sell something, how many journal entries do you think we have when they return something? 2, right? So the first thing we have to do is undo the sale. Okay. So we don't debit sales revenue. We have a special account that we do for this instance. Does anyone know what that is? Not net sales. What we use here does get us to net sales. So we have an account called sales returns and allowances. So obviously sales returns, right? That makes sense. What are sales allowances? Have y'all talked about those yet?
Yeah, isn't it like when, they don't like give you the product back? They like keep it, the person who bought it like keeps it, but you're like, I'll offer you like an allowance at the store or something, right?
Yeah, so the sales returns, right, is when the physical product is actually sent back to them, right? Sales allowances happen whenever something is usually damaged, but it's still sellable, right? So like the scratch and dent stuff at Lowe's or Home Depot, right? So instead of me paying to ship it back to you as the vendor, I'm just going to say, hey, I can sell it, but am I going to be able to sell it for new price if it's got dents and dings on it? No. So I'm not going to want to pay full price for it if it wasn't something that I did, right? So then we would call and basically negotiate an allowance. So we do keep the product and normally sell it, but then we're trying to negotiate the offset there. Okay. So how much goes into sales returns and allowances here?
150.
150, very good. And what am I going to credit? What account am I going to credit? Not sales revenue, because that would be increasing sales revenue.
Would be accounts receivable.
Yeah, in this case, we're undoing the first one here, but we don't debit sales revenue. Because again, sales revenue, we want our gross revenues for different analysis purposes, right? Because we have sales returns and allowances, right? That's going to be a key number, right? Because if they're returning things, right, we want to know why they're returning it. Maybe we're getting bad inventory and we don't know it. So we may need to figure out that part, right? If we have a bunch of sales allowances, what does that tell me? We got bad shipping, right? And if we're the ones in charge of that, we need to figure that out. And then sales discounts also goes into that net sales figure. And obviously we don't want to offset sales for discounts, right? We want to know why we gave them the discount, right? And so we keep gross sales as gross sales, and we use these contra revenue accounts, right? There's contra again. So these are contra revenue accounts. So sales returns and allowances is contra revenue. So again, it's reported with the revenues, but because it's contra, it has the opposite balance. And we'll see that in just a minute. So we've undone the first journal entry, and what do you think we're going to do with the second journal entry? So we're going to debit inventory because we're getting that money or the product back. So we're putting $100 back on the books. And what am I going to credit? Because are they sold anymore? No. So we undo the cost of goods sold. So notice that between 914 and 912, they're essentially the opposite. We just switch out sales revenue for sales returns and allowances. Bless you. All right, so here we've got minus 150. So we're left with 750 here, and then we added 100 there. Okay. So on September 21, we paid Danny Company for the September 6th purchase. So how much do I owe them?
1,300.
1,300? So make sure that you're keeping T accounts for these types of things, right? Because it would be easy to say 1,400 because that's what it was originally, but we sent back $100 worth of calculators. So we can only pay them, right? We only need to pay them 1,300. So what am I going to do? So we're going to debit accounts payable because we're paying them, right? So if we debit that, accounts payable goes to 0, right? Because we don't owe them anything. So we got 1,300 here. We got accounts payable. I think that was 921. Yeah, 921. Accounts payable. What am I going to credit? Cash, because I'm paying them cash. Very good. And then on 922, we received payment from the Great Big Bookstore. How much did they owe us? 750. So am I going to debit or credit accounts receivable? So we're going to credit 750. And basically that goes to 0. And what am I going to debit? Cash. Very good. Okay. So to wrap this up with a bow, we got what amount would Rhea report as net sales in the September income statement? So our net sales formula is sales minus sales returns and allowances minus sales discounts gives me net sales. Okay. So how much sales did I have? What was my total sales? $13. So go look at where,
Was it 500?
not 500, 900, because all we have is sales revenue of 900. Okay. And then what is my sales returns and allowances? 150. So if we go here, we got 900 minus 150. What is my sales discounts? Returns and allowances. Do we have any sales discounts? No discounts. So my net sales, $750. So then how do we get gross profit? Well, we take net sales and we subtract out cost of goods sold to give me gross profit. So what are my net sales? What we just figured out was 750. What were my cost of goods sold? When in doubt, draw a T account. So we had 600, but what else did we have? We credited 100, so how much is left? Very good. So my gross profit is 250. And then my gross profit percentage is my gross profit as a percentage of net sales. So what is my gross profit? 250. What is my net sales? So that gives me 0.33 or 33%. And remember that gross profit is what pays the bills. So it pays for all of those general and administrative and selling expenses that we have. And so what we're saying here is that for every dollar of net sales, we essentially have 33 cents that is going to pay other bills. That's what that's telling us. Okay. So for those in here, the answer key is at the bottom of this stack here. Feel free to grab one. And then before you guys jump off online, I'll go ahead and put in the chat.
Yep.
I'll put the key in there.
Those like T counts on the exam,
Say again.
make the T counts on the exam like yours and
I always default to T accounts. So yes. All right, so those that are still online, you should have the answer key. And if you're not in one of my classes, your professor should have copies of it as well. So you can reach out to them if you're not able to download it here. But if you're in my online section 13 or 14, it's in the review module. And likewise with my in-person as well.
Yeah, you could tell me.
All right, give me just 1 second and I'll try to get those permissions handled. All right, so you can try that one there. And then for you, as soon as we close down the Zoom, it'll generate a link for us. And then who's your instructor? Ms. Bentley. She'll get a copy of the link, and I don't know if she puts it in her shell, or if it goes to, like, if she sends it out to you via email. But she should send out, as long as everything works correctly, whenever it processes, then you'll have access to the link, and it should go to YouTube as well.
Yeah, so then you.
And then you've got a copy of the worksheet and the answer keys in there too, if you know.
Oh, yeah, no, I have, yeah.
Okay, perfect.
And then the second question was, when it comes down to, I guess, the word would be vocab in the sense of like
I don't have a worksheet with the keywords on it. The ebook is very good. If you go to the ebook, in the at the end of each chapter, there's a list of the keywords, and I think they're hyperlinked so that you can access them that way. Absolutely. All right, I'm gonna go ahead and shut this down.